Hello, class. I want to take this time to talk about bonds. Okay, so what is a bond? Okay, a bond is basically a debt instrument in which an investor loans money to an entity, like a corporation or a government. Okay, and the borrowed funds are for a certain defined period of time, 5 years, 10 years, 20 years, right? And the bondholders are given a certain fixed interest rate. Now, bonds are used by companies, municipalities, states, and governments to raise money to finance projects and activities. Okay? And again, the owners of the bonds are called debt holders or creditors. Okay? There are different types of bonds, such as convertible bonds, serial bonds, callable bonds, mortgage bonds, and zero coupon bonds. Okay? You know, a convertible bond is a bond that can be converted to common stock in the future. If you look at callable bonds, are bonds that can be called in before they mature. There are mortgage bonds that are secured by real estate or some other assets. Now, there's some basic terminology when it comes to bonds. You have the face amount of the bond, and that is the amount that's being borrowed. Okay? Bonds have an interest rate, or usually a fixed interest rate, and that's known as a contract rate. Okay? And so the contract rate guarantees a certain amount of interest to the bondholder. Okay, that doesn't change. And you use the contract rate to calculate the interest payments. Now there's also a market rate or an effective rate of interest, and that's basically the interest rate in the current market at the time the bond is being issued. Market rates fluctuate over time, and so oftentimes you'll have a market rate that could be higher or lower than the contract rate. And in those cases, it can create a situation where the bond has to be sold at a discount or it can be sold at a premium, which means when it's sold at a discount, it's sold below the face amount of the bond. And if it's sold at a premium, it can be sold above the face amount of the bond. A bond that's sold at a premium, let's say you have a $100,000 bond, but you can sell it or you want to sell it for $105,000. You'll have a $5,000 premium because you sold it above the face amount. We'll talk a little bit later about the amortization of bond premiums or discounts and the effect it has on the interest expense for the company. Bonds make periodic interest payments, and they could be annually, which is once a year, semi-annual, which is twice a year, or quarterly. Okay? And we'll get into talking about how do you price a bond? What do you sell a bond for? Most people say, well, if the bond has a face value of $100,000, you're going to sell it for $100,000. But if you recall, I said earlier that there's two different interest rates. You have the contract rate and the market rate. And when those two rates are different, the selling price of the bond will not be the same as the face amount. It'll be adjusted. Here's an example. On January 1st, 2014, a company issued a $100,000 10-year 12% bond for $89,592. Interest is paid annually, and the market or effective interest rate as of the date of the sale was 14%. So as you can see, we have the face amount of $100,000. The bond matures in 10 years. The 12% represents the contract rate. The $89,592 represents the selling price. You notice that the selling price is less than the face amount, so we know that it was sold at a discount, and the discount is going to be the difference between the $100,000 and the $89,592. And you have the market rate of interest. Okay, as of the date of the sale is 14%. Here's one thing to notice: when the contract rate of the bond is less than what the market interest rate is paying, or what the market rate is, the bond will be sold at a discount. When the contract rate is greater than the current market rate, you can sell the bond at a premium. Okay. Now let's talk a little bit about the time value of money and these present value tables. Okay. Now when we talk about the time value of money, a lot of you have probably heard a dollar today is worth more than a dollar tomorrow, or a dollar today is worth more than a dollar a year from now, right? And some people have trouble grasping that concept. Okay. Now the reason why a certain amount of money, whether it's a dollar or $1,000 a day, is worth more today than it is a year from now, is because of different factors such as inflation, right? Or the amount of money that you have right now can be invested for a year. So a year from now, you'll have that same amount plus possibly interest or dividends. For those that wait to get $1,000 a year from now or sometime in the future, they lose that time in which they can invest that money. So again, a dollar today is worth more than a dollar tomorrow. So we get into the present value tables here, and this is one of two tables that I want to go over. Okay. We use these tables to determine what a future amount of money is worth in today's terms. See, if we're issuing a bond to a lender, they're going to give us money today, and we're going to give them that money back in the future. Okay? But as we know, that money in the future is worth less than what they're giving us today. So we have to figure out what the discounted value is, or the present value of that future money is, to help determine the price. Okay. So let's take a look at this present value table. Okay. First of all, if you look at the far left-hand side of the table, where it says period, right? We're talking about bonds. Bonds have a specified date when they're due, and they have interest payments that need to be made, right? So a bond that matures in 10 years, that makes 10 annual payments, has 10 periods. Or a bond that matures in 5 years, that makes 5 annual interest payments, has 5 periods. Okay. Now the percentages on top, okay, will be used to determine which present value factor we're going to use to discount the bond. Okay. Now there's two interest rates that are given when we're talking about bonds. We have the contract rate and the market rate, or effective rate. Okay. The contract rate is used to calculate the interest payments that are required, but the market rate, or the effective rate, is what we use to determine the discount. And so when we're given a market rate of 4%, we go to the table at 4% here, right? Assuming that the periods are in annual terms. Again, like I said, if it's a 10-year bond with 10 annual payments and a 4% market rate, I'm going to use 4%. Now I would need to adjust it if the bond happened to be a 5-year bond, but it's making 10 semi-annual payments and the market rate's 4%. In that case, a 5-year bond has 10 periods. The market rate given is 4% annually, but I have to figure out what the interest rate is semi-annually, every 6 months. So we know that if 4% is for 12, covers a 12-month period, half of this 4% is going to be 2%. So in cases where you have bonds that make semi-annual payments, you have to adjust the interest rate accordingly, as well as adjust the number of periods. If we look at this example here, we have it says if you were to receive $100,000 5 years from now, what is it worth today? Assume that the estimated annual effective interest rate over the next 5 years is 4%. So to calculate today's value or the present value of the single amount to be received in 5 years, you multiply 100,000 by the present value factor of 0.822. Now where do they get this number? Okay, I'm going back to the previous table, and I'm going to look at 5 years or 5 periods and 4%. So 5 periods, 4%, and that's where I get the present value factor. I multiply it by that single amount, and it comes up with 82,200. That is the present value of $100,000 to be received in the future, 5 years from now, assuming the interest rate over the next 5 years is 4% per year. Now this other table is for an annuity. Annuities are basically fixed payments at fixed time intervals. For example, if someone says they'll pay you $10,000 a year for the next 10 years. So every year you're going to receive $10,000, whether at the beginning of the year or the end of the year. Okay? And that'll go on for 10 years. Each of those payments are annuities. Each amount is the same, and the time interval is the same. It's exactly 1 year. In those circumstances or cases, you can use this annuity table. But if the payment amounts are different or the time intervals are different, then you cannot use this table. So when we talk about bonds, right? Bonds that pay annual interest payments or semi-annual interest payments, the interest payments are fixed and the time intervals are fixed as well. So you can use the annuity table to discount the interest payments to figure out what they're worth today. Okay. So in this example, here you have a situation where you're to receive 5 annual installments of $20,000 over the next 5 years. That's $100,000 in total. What is it worth today? Assume a 4% market rate. Okay. So to calculate the value at the present value of the 5 future installments of $20,000, you multiply $20,000, that's one annuity payment, by the present value factor annuity, okay, from the table I just showed you. And so I'm going to go over here to 5 periods, right? And we're going to 4%, and I have a present value factor of 4.452. I'm going to multiply that, and that gives me 89,040. Okay, and that would be the present value of 5 future payments of $20,000 a year.